The Ilus, or ILUSTRATO Pictures International, has been a very popular stock for many people, and in this video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should buy the stock. As the market is still very volatile for the moment, we should always be mindful about which positions we choose to pick on. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Ilus has always been a popular stock to be traded ever since 2021, and although it remained a penny stock over the counter, it didn't stop many traders to put their trust in this acquisition company. Recently, the management issued a video asserting their goals over the next few years, stating that their sales and net income would go through the roof over the next 3 to 5 years, and in a way, it sounds very familiar, as most growth companies have expressed their intentions to buckle up and to provide the maximum amount of value to shareholders possible. Now, with that being said, usually promises like those are like surveys in nights of elections. They don't necessarily reveal the actual results in advance, they do identify trends and tendencies for those charged with governance. Sometimes that jumps to my eyes when looking at Ilus because it does remind me of another company called Ideanomics. Even though the two companies may differ in operations, ILUSTRATO is a merger and acquisition company specialized in buying companies they believe have huge potentials and to let their shareholders benefit from the growth. This is exactly what Ideanomics has been doing for a number of years, and both companies have the same kind of cyclical price actions with ups and downs. Now, let's also take a look at the technicals of the stock. The trading volume of ILUSTRATO Pictures has recently been around 8.4 million shares versus the average volume of 6.7 million shares. Over the previous 52-week period, the price fluctuated between 4 cents and 51 cents. The trading volume is a metric telling you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of a company. When we use it to compare against the average volume, it could also tell us if the company is enjoying additional momentum to reverse the trend or to break through current resistance levels. Even when the current volume is lower than the average, it could be an interesting indication nonetheless, because that could mean that a trend reversal may happen soon. The market cap of ILUSTRATO Pictures is currently around $119 million versus the enterprise value of $204 million. Simply put, the market cap is the fair market value of the company based on the current market sentiment, the company's own reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for most growth companies might be the intangibles. They're not equipments or factories, but they're pledges for a brighter future, such as intellectual properties, brandings, and schematics. For startups, most of their valuations are based on the intangibles, which could be valued in more favorable market conditions. What this means is that there can be a huge difference between the market cap and the enterprise value based on how and when they were valued, giving a false impression to the market participants that a company could be trading at a discount. It's also possible that it's just trading below the book value. It doesn't mean that a company itself is necessarily undervalued. It could also have been overvalued in the first place and only deflating back to where it's supposed to be. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right and selling the contract giving you the premiums, with obligation to execute the rights if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there are a lot of put options, there might be a possible uptrend on the move, or that the reversal might happen if there are a lot of call options. The reasoning behind the theory is very simple. Most of the options contracts tend to expire worthless. In terms of shareholder structure, institutional shareholders currently own no percentage of the outstanding shares. It is relevant to understand the shareholder composition of a company because this can help us to determine if the stock should be held long-term or to be traded short-term. Typically, the consensus is that there should be between 25 to 30% institutional ownership for the stock to be perceived as a sound investment and not just a short-term trade. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price were to fall lower. Sometimes when there is significant short interest in the total volume, that can be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is around 50% of the total float, and 42% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, the significant portion of it coming out of the dark pools, this might suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation on ILUSTRATO is to buy its shares, keep about half of the allocation for the future, and to benefit from additional retracements. Of course, it goes without saying that a company is on the riskier side of things, so definitely make sure that your portfolio is sufficiently balanced to take on such a position, if that is your choice. I would recommend to commit a total of 0.5 to 1% of your portfolio in the stock, and would recommend you to split the allocation in batches of 20% at a time so that you can benefit from further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years, or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.